Welcome, ladies and gentlemen, to Lesson 10, Current and Long-Term Liabilities. Alright, before you go through this lesson, I want to advise you, please go through Lessons 2, 3, and 4. 2, 3, and 4 cover some important concepts that you need to know before you get into this lesson, including journal entries, adjusting journal entries, closing entries, accrual entries, deferral entries. You need to understand what those are before you can get to this lesson. Alright, so let's get into it. Current and long-term liabilities. On the right side of your cheat sheet, you'll see some concepts and definitions. We'll go through those first, then we'll get into some actual transactions and some journal entries. All right, current liabilities. Current liabilities are due within 1 year or the company's operating cycle, whichever is longer. All right, similar to what we saw in Lesson 2 on the balance sheet on our chart of accounts. We went through the different types of accounts. We said current liabilities, long-term liabilities. On the chart of accounts, we identified which accounts are in those buckets. We're just going to go through some examples, and you'll have on that Lesson 2 cheat sheet, you also have the chart of accounts that gives you examples of current and long-term liabilities. All right, examples of current liabilities: accounts payable, purchases of goods or services on credit. Accrued liabilities, and expenses incurred in one accounting period. The cash payment is made in a later period. Notes payable, this is the current portion of a notes payable, occurs when one company borrows money from another. Sales tax payable, liability resulting when a company collects sales tax from the state, collects sales tax from a customer for the state. And unearned revenue, we've been through a transaction with unearned revenue in our closing entries, our revenue transaction. So we're pretty familiar with unearned revenue. The receipt of cash before goods or services are provided. Getting into long-term liabilities, some examples of long-term liabilities: private placement debt, that could be borrowing money, i.e. a line of credit or a note payable. And this is the long-term portion of the note payable. Publicly issued debt, borrow money, bonds payable. Notes payable, this is the long-term portion of notes payable. It occurs when the company borrows money from another. Measurement of liabilities, important concept. The initial amount of the liabilities. A liability is recorded as cash equivalent, which is the amount of cash that a creditor would accept to settle that liability immediately. Additional amounts owed to the creditor. Liabilities are increased whenever additional obligations arise, including interest charges. Payments or services provided to the creditor. If additional payments or services are provided to the creditor, that'll reduce the liability. Liabilities are reduced whenever the company makes payments or provides services to the creditor. All right, so those are the concepts and definitions. Probably not unfamiliar to us at this point. We've gone through the common transactions from Lesson 2, Lesson 3, our closing entries from Lesson 4, and some other, if you've gone through the other lessons, you see some similar entries. All right, so let's get into some examples. We're going to go through a payroll expense entry. Here's the given in the top left corner. 1, round billies payroll expenses are listed below. Prepare a journal entry to record the payroll and related expenses. So salaries and wages earned by employees, 1.8 million. Less income taxes withheld from employees. All right, so those are income taxes that we owe, the employee owes, but we withhold it from the employee on their behalf. FICA taxes withheld from employees. Same thing. You know, I don't know if you know this. You know, a company, they and an employee, they both owe FICA and income tax. The FICA tax is both the employee and the company are both liable, and what happens is the company withholds that tax from the employee. Like when you get your paycheck and you have all those deductions, you're like, what the heck? I had a gross amount of this, and all of a sudden I'm only left with this. What happened to the rest? Okay, well the FICA tax is withheld by your employer because you owe it and they owe a portion. The income tax is withheld by the employer because they need to remit it to the government. And sometimes you get a credit back if you don't owe that tax at the end of the year. But anyway, those withholdings are reduced from our ultimate cash payment. In this example, you'll see the cash payment is different from the expense. All right, okay, get into the journal entry. Compensation expense equals 1.8 million. That's the gross amount. Now, the company needs to increase liabilities for the income taxes withheld and the FICA taxes withheld. Those aren't the companies. They keep that money from you, but the company doesn't own that. They owe it to somebody. That's not theirs. They owe it. So they need to record a liability. And so you'll see the equal liabilities there. And then the cash payment out at the time of this entry is the $1.42 million. So those are the journal entries. Now, as I said, the FICA, you owe FICA taxes, and the company owes FICA taxes because you're their employee. So they owe an equal amount, and this entry down here below demonstrates that. And I don't know, I don't know how specific your class or your instructor is going to be about the FICA and that withholding tax, but this is just an example to walk you through it in case you do see it. Unearned revenues, like I said, this isn't something that's unfamiliar to us. We've seen unearned revenues a couple times. We're going to walk through this transaction. On December 1st, 2010, Roundbelly received $5,000 in advance for a boat rental in connection with a party on December 31st, 2010. All right, stop. Remember, accounting's easy. Does a transaction a gift? So we're goods, services, resources exchanged. Yeah, we got cash, right? Okay, so this is a good transaction. Let's go on. What accounts? Well, we got cash, right? Got cash, debit cash. And then we owe this rental. This person is going to get a service later. We owe them something. So that's liability, increased liability. The entry, debit cash, credit liability for $5,000. All right, next portion of this example. Roundbelly executed the rental December 31st, 2010, and makes the following entry. Okay, now that we've exchanged those, now that we've given them a rental, we've rendered the services, we no longer owe that liability. Now we can recognize revenue, right? We've given them the services, recognize the revenue. We don't owe them anything else. So what do? We got to decrease that liability that we initially recorded for the unearned revenue. Debit liability. Credit revenue. Increase revenue through a credit, you decrease the liability through a debit. That's the final entry there on number 2. Now, getting into number 3, sales tax. Okay. I hate sales tax. I'm sure you guys do. You go to a store, you see a price tag. Oh, this costs $5. You get to the register, they scan it, and it comes out, it's like $5.60. You're like, well, I thought it was $5. Well, that's because most stores will add the sales tax on top of the purchase price, and that sales tax is not revenue to them, it's a liability. They're collecting it on behalf of the state. They're an agent of the state at that point. So you're giving them money, and they're just giving it to the state. They don't keep that money. Let's walk through the transaction. Roundbelly sells 10 Life Vests for $800 and collects the required 6% sales tax for the state. Now, in the problems that you're given in your homework or an exam, they'd give you the sales tax, or percent, that'd be a given. All right, but the entry is cash, $848. That 6% times the $800 is $48. We need to add that on top of the $800, right? Because that's how much cash you give. That's out of your pocket. And so that's out of your pocket to the company's pocket. The company gets the cash, increased cash, debit cash, $848. They need to get a liability for the $48 for the sales tax they collected that they're collecting from you on behalf of the state. They don't own that. They owe that to the state. So credit liability, increased liability, and then they can recognize revenue for the sale, the $800 sale. Now let's get into a note payable example. 4. Roundbelly borrows $25,000 from First Republic Bank at an annual rate of 12%. On August 1st, 2010, Roundbelly would make the following entry. Alright, so the note payable is executed on August 1st. They make this following entry. Cash, we get cash, right? Transaction occurs, we get cash, and now we own some. Debit cash, credit liability, credit note payable. So that's the entry. Now, that was August 1st. 4 months later, December 31st, what entry would be made on December 31st, 2010 for the year ending for the year end for Roundbelly? Remember, this is one of those unobservable events. This is an accrual adjustment. This is one of those adjustments we got to say. Did something happen? Were goods or services exchanged? Did a transaction exist? Yes, a transaction exists. It's unobservable, but it does. We owe them money. Those goods and services need to be exchanged. We've received the benefit of the borrowing of the money, and we owe that expense to the bank. All right, so we need to record the transaction. I'm going to walk through it. The calculation is down below. Interest is the $25,000 times the 12%. Times 4 divided by 12, because the 4 divided by 12 has been 4 months that we need to accrue, divided by the 12 to get our annualized rate. All right, so that's the entry we make. It's a debit expense, credit interest payable, an accrual adjustment, right? You increase the expense and you increase the liability. On August 1st, 2011, Roundbelly must pay the interest and principal on the note. Okay, so this is a year after. The note is now due. We need to pay not only the interest, but the principal. Okay, so what's the transaction? So definitely cash is going out the door. We're repaying the note, and now there's additional interest. There's that extra 8 months of interest that we need to recognize an expense, and then we need to pay out as cash, right? So the total annual interest calculation is down below. It's $3,000, right? Because it's the 25,000 times the 12%. Now that's the total interest. But go back to above. We've already recorded 1,000. So now we only need to recognize interest expense of 2,000. Reduce the payable that we previously recorded, but through a debit, right? Because we increased it by a credit. Now we need to decrease with a debit. So we debit 1,000, and the cash that goes out, the actual cash out, is that $3,000 for the interest. In addition, the cash that's going out is $25,000. Down below, debit cash for 25,000, credit note payable. Those are the entries on a typical entries for a note payable. Now let's move on to 5. Early retirement of debt. On January 1st, 2011, Roundbelly issues, at face value, $10 million of 3-year bonds payable. The bonds pay annual interest at 10%. On December 31st of each year, the bonds pay 10% on December 31st of each year. Okay, on December 31st, 2011, all right, so 1 year, the company retires the bonds by purchasing them in open market for a total cost of $10,400,000. All right, what are the entries? Okay, so this is a little complicated. We issued $10 million in bonds. Those bonds pay 10% interest annually, but we go out and it's a 3-year